Under the UAE Corporate Tax Law, if there is a business restructuring which is carried out between two taxable persons and certain other conditions are met, as in, they are taxable person, they are member of the same qualifying group, amongst others, the transfer of business in entirety or a part of a business is not liable to UAE corporate tax. This would also be applicable in case, one of the entities, the transferor, goes ahead and merges with the transferee and the transferor ceases to exist. Now, there were certain conditions which were prescribed in relation to when these business restructuring would be considered as a tax exempt event. However, certain aspects have now been further clarified in the Ministerial Decision number 133 of 2023 that we are going to discuss now in the subsequent slides. Now, when there is a transfer of business from one taxable person to another, the consideration for this can be discharged in the form of shares or ownership interest, as well as certain other forms of consideration. Now, when it comes to other form of consideration, there's a limitation in terms of what would be the value of this particular form of consideration as a percentage of the total consideration issued in respect of such a transfer of entire business. So under the ministerial decision, it has been specified that to claim the tax exemption, the market value of the other form of consideration, which could be in the form of cash or some other form, should not exceed the lower of the following two values. The first is the net book value of the transferred assets and liabilities, and the second is 10% of the nominal value of the issued ownership interest. What this means is, let's say, if the issued ownership interest, the value of that is, let's say, 100, the other form of consideration should not be more than 10%. Similarly, it should not be more than the net book value of the transferred assets and liabilities. So if it exceeds the lower of these two, so let's say if this was 100 and this is 50, the lower of the two will be 50. If it exceeds 50, and this assuming the market value, right? In such a case, the exemption which was available for business restructuring relief will not be available. Now, when we talk about, the exemption from taxability on business relief, business restructuring, basically, we say that the transfer should be in consideration of ownership interest. What exactly is the meaning of ownership interest? That is something which we are going to see now. Ownership interest means that, when there is a transfer of business from one taxable person to the other taxable person, the transferee, in consideration of the acquisition of the business, issues either of these following instruments. One is the ordinary shares. The second are the preferred shares. Preferred shares are the one which basically entitle the holder of such shares to a preferred distribution of profits or the assets in event of liquidation. Ordinary shares obviously give them the ownership right into the company. Redeemable shares, membership, and partner interest. This would be in a case where a business has been transferred to a unincorporated partnership, or other securities, capital contributions, and rights which entitle the recipient, that is the transferor of business, to profits and liquidation proceeds in the transferee. So when any of these is transferred as a consideration for acquisition of business between two taxable persons, this is referred to as ownership interest. Now, the other condition is that even though these instruments are received by the transferor of business, the other condition that is to be met is that such an ownership interest, that is, whether it is the equity share, the preference share, the redeemable share, or any of the preceding things that we discussed, should be classified as equity interest under the applicable accounting standards applied by the taxable person who is holding the ownership. In other words, in the example, if we see here taxable person 1 has transferred the entire or part of business to person 2. And in exchange, there has been a distribution of shares or ownership in taxable person 2 to the taxable person 1. If this part that is acquired, the ownership interest or the shares that are acquired by taxable person 1, is classified as ownership interest in the books of person 1, after applying the applicable accounting standard, then it will be considered that this is an ownership interest. The second condition is that the taxable person will be treated as holding open interest, ownership interest, where such ownership interest is controlled by the taxable person, and the taxable person has the right to economic benefits produced by the ownership interest. In other words, this person should be able to control the ownership interest that he receives as a part of this transfer of business. And second is the economic benefits, which would be in the form of dividend or capital gain, should accrue to this taxable person 1 as a result of this transfer. Now, the business restructuring relief which is available is not available by default. The person who is actually transferring the business has to make an election. That is, the transferor has to make an election to apply the business restructuring relief to the transfer that is happening, provided this relief meets the required condition as applicable under the UAE Corporate Tax law. In addition to this, both the transferor and the transferee are required to maintain the relevant records in respect of such a transfer, whereby they can demonstrate that they meet the condition of the business restructuring relief. The second point is that once this relief is available, the conditions are met, then the adjustment to the taxable income of the transferor and the transferee would be done as per the ministerial decision on general rules for determining taxable income. This would be arising because there will be a transfer of certain assets from the transferor to the transferee. And therefore, these have to be reduced from the books of accounts here and added here for the purpose of claiming amortization in the hands of the transferee and removing the same in the hands of the transferor. Now, basically, once the business restructuring relief is done, the question that comes up is, what about the unutilized tax losses of the transferor? Now, in such a case, the unutilized tax losses of the transferor, which were incurred prior to the tax period when the transfer is completed, can be transferred and carried forward by the transferee. However, the condition in such a case is that the transferee should continue to carry on the same or similar business activity. Now, what are the relevant factors which will be used to ascertain whether the transferee is carrying out the same or similar business activity? The first one is that the transferee uses either some or all of the assets which were used by the transferor prior to the transfer. If you transfer a business, but the assets which are being used are totally new, there's not even a single asset which was used by the transferor, in that case, the same or similar business activity test would not be met. There is no significant change to the core identity or operations of the business. So let's say if a company was earlier into service in the IT sector, and later on also it continues to provide services in the IT sector, although maybe they were providing software X earlier and now they are doing X plus Y, the very core of the business does not change, even though some products might have been added. Therefore, it can be said that there is no significant change to the core identity or operations of business. However, even if there are any changes, these changes should be arising out of either the development of the assets or services or processes or products or methods which existed before the transfer. So it should not be that there is something totally new that comes in, the old business is no longer there. And the purpose behind all this exercise is that, if company A, let's take an example here, if company A and company B are there, company B is a profit making company, whereas company A has carried forward tax losses. The purpose of the business restructuring should not be merely to transfer these tax losses. The idea is if A's business is transferred, that business should be carried on by B. If B does not intend to carry on this business and the purpose was more to get the benefit of the tax losses, that would not be something which will justify the transfer of tax losses from A to B. Now, in most of the cases, what would happen is that the transferee is going to issue shares or ownership interest, and the same would also be received by the taxable person. But in some cases, what can happen is if the taxable person ceases to exist, the shares or ownership interest might be received by a third person. Similarly, instead of the person who's actually getting the business under the business relief, some fourth person may actually issue their shares as a consideration of this transfer of business. Another provision of this decision where shares or open ownership interest is received by a person other than a transferor, that's let's say a third person in this case, the recipient, that is the third person, should have a direct or indirect ownership interest in at least 50% in the transferor. So if he receives this share, that is absolutely fine, so long as they own at least 50% stake in the transferor. Similarly, if shares or ownership interest can be issued by a person other than the transferee, provided the issuer should have direct or indirect ownership interest in at least 50% in the transferee. So if this fourth person actually has at least 50% in the transferee, which is taxable person 2, then this condition can be met. So basically what happens is that if the provision of business restructuring relief apply, there is no taxation in the hands of the transferor. However, in the following cases, the taxation in the hands of the transferor can arise on a subsequent date. And what are these events? The events are basically if the shares or ownership interest of the transferor or transferee are transferred outside the qualifying group. So let's say, for example, both these entities formed part of a qualifying group and company X owned 100% each in these two entities. If X subsequently transfers the stake in the transferor or the transferee to Y, which is not a part of the qualifying group, in that case, the tax which was exempt on transfer is going to resurface and will need to be paid by the transferor. Or secondly, if there is a subsequent transfer or disposal of the transferred business. So let's say this business was transferred to the transferee, and after 1 year, the transferee actually sold the business to someone else. In that case, again, there will be tax liability in the hands of the transferor. However, the tax liability will not arise in the hands of the transferor, but will be applicable in the hands of the transferee if the transferor ceases to be a taxable person or the transferor is a natural person. In both these cases, let's say if this guy is a natural person or he ceases to be a taxable person, the tax liability will be in the hands of the transferee entity. Now, under the UAE corporate law, both the transferor and the transferee are under an obligation to maintain a record of the agreement to transfer business. And in addition to this, they also need to keep a record of the adjustments which are prescribed by the ministerial decision on the general rules for determining taxable income in the case of transfer of business. These have to be maintained by both the transferor as well as the transferee.